What's up, guys? So, if the efficient market hypothesis was correct and accurate, then wouldn't the share price of a stock match the net asset value per share or the book value per share? Well, if you look at the stock market, this almost is never the case. That's why people make so much money off discounts, and that's why there's such thing as bargains when you're buying shares. So, I wanted to make the video just to talk about the efficient market hypothesis. It's an economic term. I don't know who coined the term, but it basically says um, it's based on the idea that economic actors, which is the public, which includes me and you, have the relevant knowledge to be able to make purchases, economic purchases. So if you go out to the supermarket and buy some groceries, the efficient market hypothesis would say that you and I, or you that are buying the groceries, have the sufficient amount of information or the relevant information necessary to buy the product at as close to the actual intrinsic value of the product as possible. I think the efficient market hypothesis says that you have the when economic actors are making purchases, they have they're rational in the sense that they have the relevant information to be able to make the purchases based on the based on the actual intrinsic worth of the things that they're buying. So, for example, if I'm buying some carrots, and the intrinsic worth of the carrots is £1 per kilogram, a rational economic actor would not buy 1 kilogram of carrots for any more than £1 per kilogram, and that's what the efficient market hypothesis suggests, that human beings and economic actors are rational agents that, when going out into the marketplace, are rational enough to be able to make decisions to buy things based on their intrinsic worth and their actual value. So if you look at the stock market, this is almost never the case. The market cap, or the market share of a share, or the market price of a share of stock is almost never the same as the actual value of the stock. And by actual value, I mean, if you look at the accounting of the company, if you look at the assets of the company, or if you were to sell, the best way I like to describe intrinsic values is if you were to sell everything that company owns and you were to convert it into cash, and you were to pay off all of its debts and all of its liabilities, you were to give all of the shareholders all of their money back, and you were to be left after expenses with the cash, would there be a positive amount of cash, or would it just be break even? Would there be zero cash, or would there be a negative balance? So if there's a negative balance, then the company is then the company the company's share price is higher than its intrinsic value. If there's zero cash, or if break even, then that's what the efficient market hypothesis would say, is would say that the the efficient market hypothesis would say that an economic actor would be right to purchase a share at that point, because the intrinsic value, the intrinsic value matches the market value. Market value matches the intrinsic value. If there was um, if there was positive cash afterwards, if you had cash left over, then that means the market price, sorry, would still not be the same as the intrinsic worth, but it would be in a positive direction. So I'm not too sure if the efficient market hypothesis would suggest that the agents are rational. I think they probably would, because you're gaining. So rational agents always, uh, a rational agent would be someone that, I guess, would want to either profit or at least break even. So if you were to go to the grocery store, you would at least want to buy something for its intrinsic worth, or you would at least want to buy it for lower than its intrinsic worth. So that way, if you were to sell it, then you will be able to get more than what you paid for it. Or at least if you consume it, then at least you got a discount, you got a bargain. So that's the efficient market hypothesis. Connect it with I wanted to connect it with the stock market, and to answer the question that I asked at the beginning of the video, does the efficient market hypothesis suggest that if you apply the efficient market hypothesis to the stock market, what can you find out? So you can find out that economic agents like me and you, are almost never rational when it comes to buying and selling stocks, because the market prices on some stocks, takes for example HSBC, is completely far off the intrinsic value. HSBC, I think if you were to buy the entire company, you would make like 60 or 80 billion dollars or pounds, I don't know. That's how much difference in price that there is with regards to HSBC alone. There are other companies that are just as bad or very similar in terms of the difference, but it is the way it is. I guess the efficient market hypothesis is wrong. We're not all rational agents, because if to be a rational agent, you would need the sufficient information necessarily to make a rational decision. And I guess people don't base their decisions, not only in the stock market but in general purchases. I guess they don't base their purchasing decisions, based on rationality, but based on something else. Some people would argue it's emotions. Anyway, I'm going to cut this video short. Thank you guys for watching, and I hope you got some value. See you in the next one.